Why do we crave wealth so much, yet often make completely irrational decisions with our money? And why is it that some of the most educated, intelligent people end up failing financially, while ordinary folks who seem totally unremarkable manage to quietly build massive fortunes? Today, we're diving into a global classic on the psychology of wealth, The Psychology of Money, by Morgan Housel. This isn't your typical finance book. With over 8 million copies sold worldwide, it's a longtime bestseller that reveals the human nature behind money, helping you make smarter choices and understand the real link between wealth and happiness. Consider this story. A brilliant young tech genius worth millions at a young age once threw gold coins into the ocean just for fun and shattered a $500 lamp in a restaurant, tossing the manager $5,000 to keep quiet. Sounds like he had more money than he knew what to do with, right? Yet, just a few years later, he was completely broke. Now, contrast that with Ronald Read. He was a humble man who worked his whole life as a gas station attendant and a janitor. He lived a simple, modest life, and no one had any idea how much money he actually had. When he passed away at age 92, everyone was stunned to learn he had quietly amassed over $8 million. He didn't have any insider tips or fancy strategies. He just saved a bit from every paycheck, invested it regularly, and patiently let compound interest work its magic. He even donated most of his fortune to his local hospital and library. These two extreme stories perfectly capture the core idea of the psychology of money. When it comes to wealth, how smart you are or how much you know matters far less than how you behave. Financial success is more of a soft skill. It requires emotional discipline and patience, not complex formulas. Your habits and your ability to manage your emotions are what really determine whether you'll end up rich or broke. So here's the big question. If behavior is so crucial, why do we still act so irrationally with our money, sometimes making choices that seem completely crazy to others? Have we lost our minds? What psychological forces are at play here? In the next section, we'll dig deeper into that very question. Ever seen a genius go broke while a janitor quietly builds a fortune? It teaches us a powerful lesson. Managing money isn't about how smart you are, it's about how you behave. But that raises a huge question. Why do we so often make money decisions that, to others, seem completely irrational, even a little crazy? Have we all lost our minds? Well, here's a surprising idea. Nobody is truly irrational with their money. You heard that right. All those seemingly crazy behaviors, living paycheck to paycheck, impulse buying, gambling on risky stocks, or even that tech millionaire who literally skipped gold coins into the ocean. They all make perfect sense to the person doing them at the time. Their logic might seem absurd to us, but for them, it's based on the information they had and their personal understanding of how the world works. Why is that? Because every single one of us views money and the world through the unique lens of our own life experiences. The family you were born into, how your parents talked about money, the economic climate when you were a kid, whether you lived through boom times or recession. All of it shapes how you think about risk, reward, and wealth. Even though your personal experiences are just a tiny fraction of what's happened in the world, they probably make up 80% of how you think money works. We simply trust what we've personally lived through more than what we read in a book. Think about it. Someone who grew up in extreme poverty versus someone born into a wealthy family of bankers, their ideas about risk couldn't be more different. The first person might see any risk as a danger that could destroy everything. The second might see taking risks as the only way to grow wealth. Or take people who lived through hyperinflation, when their currency became worthless. They might avoid bonds for the rest of their lives because, in their memory, bonds equal financial ruin. But for someone who grew up in a stable economy, that fear seems ridiculous. To them, bonds represent safety. Let's look at the stock market. If you were a teenager in the 80s and 90s, you saw the S&P 500 grow nearly tenfold. You'd probably be pretty optimistic about stocks. But if you were born 20 years earlier, You saw the market go almost nowhere during those same formative years. You might think stocks are a total scam. This isn't about who's smarter, it's about living in different worlds. We think we understand how things work, but really, we've only experienced a tiny slice of it. As one investor said, some things you just can't understand until you've lived them. You can study all the data about the Great Depression, but you'll never truly grasp the feeling of coming home, looking at your family, and wondering if one bad investment just ruined their future. That kind of emotional weight can't be learned from books. Here's a striking example: lottery tickets. In the U.S., the lowest-income households spend, on average, over $400 a year on lottery tickets. That's 4 times what wealthier families spend. It sounds insane, right? Especially when many of these same people don't have $400 for an emergency. But we're not living their reality. Imagine working exhausting hours, barely making enough to get by. Saving feels impossible. A house, college for your kids, even good health care, they all feel completely out of reach. In that situation, spending a few dollars on a lottery ticket isn't about probability. It's about buying hope. It's the only visible chance they have at a better life. We don't understand it because we're already living inside the dream they're chasing. What looks irrational often has a heartbreakingly logical reason behind it. Once you realize this, you see that most money decisions aren't made on a spreadsheet. They're made at the dinner table, shaped by our unique experiences, our pride, our fears, and our dreams. And let's be real, things like 401ks and student loans haven't even been around that long. We're all just beginners in this modern financial world, figuring things out as we go. So, the next time you see someone make a financial choice that seems absurd, try to judge a little less. Ask yourself, what life experiences could make that choice feel logical in their world? And be gentler with yourself too. Looking back at your own mistakes, you probably weren't being foolish. You were just making the best decision you could with the knowledge you had at the time. But if everyone is acting rationally within their own logic, why do financial outcomes still vary so wildly? Is it all just down to different experiences? Or are there other, unseen forces at play? In our next video, we'll explore the mysterious twins that shape our financial destinies: luck and risk. We've talked about how our past experiences shape our relationship with money, making our financial behaviors, no matter how odd they seem to others, perfectly logical to us. But does that mean our financial destiny is just a product of our past and the choices we make today? Or could it be that while we're busy planning and analyzing, there are invisible forces quietly shaping our financial outcomes? The answer is a resounding yes. Every result in life, especially with money, isn't just about your hard work or intelligence. It's also influenced by 2 powerful, ever-present forces: luck and risk. They're like twin brothers, always around, yet we almost never give them the credit or blame they deserve. As NYU professor Scott Galloway puts it, nothing is ever as good or as bad as it seems. To understand this, let's look at someone we all know: Bill Gates. We see him as a genius, brilliant, driven, and way ahead of his time. But there's a crucial part of his story that often gets overlooked: his high school. Gates went to Lakeside School in Seattle. Back in 1968, it was one of the very, very few high schools in the entire world that had a computer. Think about that. Most university labs didn't even have one, but a forward-thinking teacher convinced the Parents Club to rent a computer terminal. Let's break down the odds. In 1968, there were about 303 million high school-age students worldwide. Only about 300 of them attended Lakeside. That's literally a 1 in a million shot. Gates himself has said, without Lakeside, there would be no Microsoft. So yes, his success came from incredible intelligence and hard work, but it was ignited by a 1 in a million stroke of luck. But luck has a twin, and its name is risk. While Gates and his friend Paul Allen were coding away in that computer room, there was a third student with them, a close friend named Kent Evans. Gates described him as the smartest kid in their class, sharing the same dream of changing the world with computers. The plan was for the three of them, Gates, Allen, and Evans, to start a company together. But just before graduation, tragedy struck. Kent Evans died in a mountain climbing accident. The odds of a high school student dying in a climbing accident? Roughly 1 in a million. Do you see the chilling symmetry? A 1 in a million event gave Gates his opportunity, and a 1 in a million event took that same opportunity away from his friend. That's risk. The same force, the same randomness, just pointed in the opposite direction. Luck and risk are constant reminders that the world is far more complex than we want it to be. There are countless factors beyond our effort or skill that shape our lives in unpredictable ways. The problem is, these forces are incredibly hard to measure and even harder to accept emotionally. When we see someone else succeed, it's easy to say, "Oh, they just got lucky." But when we succeed, admitting luck feels like it diminishes our own hard work. Conversely, when we fail, blaming bad luck sounds like making an excuse, so we blame ourselves instead. This creates a dangerous trap. We see other people's failures as a result of their bad decisions, but our own failures as the result of bad luck. We crave simple stories. He failed because he made a poor choice. But that ignores the reality of risk. We study the habits of successful people, trying to copy what they did, but we rarely ask how much of their success was skill and how much was pure, unrepeatable luck. Think about business titans like Rockefeller. They often bent or broke the law. History now calls them bold and visionary. But what if luck had turned against them? Those same actions could have led to bankruptcy or prison. The line between bold and reckless is razor thin and only ever visible in hindsight. So what does this all mean for us? It means we need to adjust our mindset. When you succeed, practice humility. Remember that luck was a partner in your success. It doesn't mean you didn't work hard. It just means you're not invincible. And when you fail, practice self-compassion. Failure isn't always a sign of a bad decision. Sometimes you just ran into the unforgiving side of risk. Don't let a single setback destroy your confidence or your plans. The goal is to build a financial life that's strong enough to survive mistakes and bad luck, so you can stay in the game long enough for good luck to find you again. Now, let's say you've accepted all this. You've worked hard, you've gotten lucky, and you've built real wealth. You've made it. You have enough. Does that mean you can finally relax and be happy? Or could it be that once we get what we need, we fall into an even more dangerous trap, one that we dig for ourselves? In the next part, we'll explore that very human flaw, the never-ending and often destructive pursuit of more. In the last video, we talked about luck and risk, the twin forces that quietly shape our financial lives. They remind us to stay humble in success and be kind to ourselves in failure. But what if you've worked hard and gotten lucky? You've built some real wealth. Does that mean you can finally relax? That you've made it? Unfortunately, it's not that simple. Because right at that moment, another, sneakier, and perhaps more dangerous psychological trap appears, the temptation of never feeling satisfied. There's a famous story about the writer Kurt Vonnegut. He was at a party with his friend Joseph Heller, who wrote the classic novel Catch-22. Vonnegut pointed to the host, a hedge fund manager, and said, "Joe, that guy made more money yesterday than your best-selling novel has ever made in royalties." Heller just smiled and replied, "Yes, but I have something he'll never have, enough." Those two words, "I have enough," are a wake-up call. The ability to feel that you have enough to know when to stop is an extraordinary kind of wisdom. Sadly, it's a wisdom that many people, even the wealthy and powerful, never learn. Why is this endless desire for more so dangerous? Because it constantly moves the goalpost. You hit your first milestone, maybe your first $1 million, and it feels amazing. But then you see someone with 10 million, and suddenly your goal shifts. When you reach 10 million, you start envying those with 100 million. Your desire grows faster than your wealth ever can. The result? No matter how much you have, it never feels like enough. You always feel behind, always chasing, and the only way forward seems to be taking bigger and bigger risks. You end up running after a finish line that keeps moving until one day you collapse or fall off a cliff. The book tells two heartbreaking real-life stories. The first is Rajat Gupta. His life reads like a movie. Born in the slums of Kolkata, India, and orphaned at a young age, he rose through sheer willpower to become the CEO of McKinsey, one of the world's top consulting firms. After retiring, he served on major boards, worked with Bill Gates in philanthropy, and had a net worth of around $100 million. He could have done anything he wanted, but he didn't feel like he had enough. Watching hedge fund managers worth billions, he got restless. He wanted to be one of them. That envy pushed him to take reckless risks. During the 2008 financial crisis, he used insider information from his position on Goldman Sachs' board to tip off a hedge fund manager. 16 seconds before the public announcement of a major investment by Warren Buffett, Gupta made a call. His friend bought 175,000 shares and made $1 million almost instantly. Eventually, they were caught. Gupta lost everything. His career, his reputation, his freedom, all for the chance to make just a little more. Then there's Bernie Madoff. Everyone knows he ran one of history's largest Ponzi schemes. But what people forget is that before the fraud, Madoff was already an extremely successful and legitimate businessman, earning tens of millions a year. He was already rich. And yet, he wasn't satisfied. He turned to fraud, destroying the lives of thousands of investors who trusted him. He died in prison, disgraced and alone. Why would men who had unimaginable wealth, status, and freedom risk it all for money they didn't even need? The answer is simple. They never learned the concept of enough. Now, most of us will never face $100 million temptation. But that same restless mindset, the quiet belief that just a little more will finally make us happy, affects almost everyone. Modern society is incredibly good at creating two things: wealth and envy. Seeing others with better cars, bigger houses, and fancier vacations can be a powerful motivator. But when comparison never ends, happiness becomes impossible. So how do we fight this never-enough mentality? First, beware of social comparison. There will always be someone richer. A baseball rookie making $500,000 a year feels poor next to a superstar earning $36 million. But that superstar feels tiny compared to a billionaire tech founder. There's no ceiling. The only way to win is to stop playing the game. Focus on your own journey. Accept that good enough is truly good enough. As a Las Vegas dealer once said, the only way to win in Vegas is to walk out the minute you walk in. The same rule applies to the game of wealth comparison. Second, understand that enough isn't about giving up ambition. It's about recognizing risk. It's knowing when to stop chasing and start protecting what truly matters. And what matters? Your health, your freedom, your family and friends, being loved and respected, your inner peace. Once you lose these things, no amount of money can buy them back. Risking them for wealth you don't need is pure foolishness. So if the endless pursuit of more is so dangerous, is there a safer, steadier way to grow wealth? Absolutely. It doesn't rely on greed or reckless risk. It relies on time and patience. And that brings us to our next big idea, the quiet magic of compounding. In the last part, we talked about that dangerous mental trap of never feeling satisfied, that endless craving for more that can make us lose sight of what truly matters. So, is there a safer, more sustainable way to build wealth? Absolutely. And its power might be far greater than you can imagine. It's called compound interest. Now, you might be thinking, Compound interest? That sounds like something from an old finance textbook. It definitely doesn't have the excitement of those get-rich-quick-tonight stories we see all over the internet. But the book, The Psychology of Money, reminds us that compounding is one of the most powerful, yet most underrated forces in investing. Its magic is simple. When your returns start generating their own returns, even a small starting amount can, with enough time, snowball into something massive. So why do we so often overlook it? Because compounding works exponentially, but our brains are wired to think linearly. If I ask you to calculate 8 plus 8 plus 8 plus 8 plus 8, you can instantly tell me it's 40. But if I ask you to figure out 8 times 8 times 8 times 8 times 8, your brain probably hesitates. The book uses a brilliant analogy to explain this: the formation of Earth's ice ages. Most of us probably assume the Ice Age happened because winters suddenly got brutally cold. But scientists discovered the real cause was likely something much subtler, a series of summers that were just slightly cooler than usual. Those mild summers didn't melt all the snow from the previous winter. That thin, leftover layer of ice then reflected a little more sunlight the next year, keeping the planet a tiny bit cooler. Cooler summers led to more unmelted snow, which led to more sunlight being reflected, which led to even cooler temperatures. It was a self-reinforcing loop. Over thousands of years, those tiny, almost invisible differences built up, and that thin layer of snow eventually grew into massive glaciers covering entire continents. Wealth works the exact same way. There are countless books out there analyzing Warren Buffett's investing strategies, how he picks stocks, how he values companies, what metrics he uses. But this book highlights a much simpler and far more powerful truth. Buffett's staggering wealth didn't just come from being a great investor, it came from being a consistent investor, one who started early and never stopped. Let's look at the numbers. Of Buffett's roughly $84.5 billion net worth at the time the book was written, $84.2 billion of it was earned after his 50th birthday. Even more astonishing, $81.5 billion came after he turned 65, the age when most people retire. Think about that. Nearly all of his wealth was built after the point when most people stop working. What does this tell us? It shows that Buffett's true secret isn't just his impressive 22% annual return. It's that he has allowed that return to compound for over 75 years. Imagine if Buffett had lived a more typical life, maybe exploring the world in his 20s, starting to invest seriously at 30, and then retiring at 60. Even if he'd earned that same incredible 22% annual return, the book estimates his wealth today would be around $11.9 million, not $84.5 billion. That is a 99.9% difference created by nothing more than time. In the world of compounding, time is the magic multiplier. It's the invisible force turning small beginnings into unimaginable outcomes. Now, compare Buffett to another investment legend, Jim Simons, founder of Renaissance Technologies. His annual returns are a mind-blowing 66%, 3 times Buffett's rate. You'd assume Simons would be far richer, right? But his net worth is around $21 billion, much less than Buffett's. Why? Because Simons didn't start investing seriously until he was 50. His compounding clock started decades later. This contrast proves a profound point. Time in the market matters more than getting high returns for a short period. But because compounding is so counterintuitive, slow at first, explosive later, we tend to underestimate it. We're drawn instead to strategies that promise the highest short-term gains, the next big trade, or some secret hack to instant wealth. We obsess over market timing and trading tactics, while ignoring the simplest, most powerful tool of all, time. We rarely stop to think about what could happen if we simply waited, if we just let time and compounding do their quiet, miraculous work. There are over 2,000 books about Warren Buffett's success, but you'll almost never see this on the cover. He's been investing for 75 years. And yet, that's the real headline, That's the key. So, what's the big takeaway here? The most important lesson is this. A good investment doesn't have to deliver the highest short-term return. Those high-return strategies are often impossible to sustain and usually come with huge risks. A truly great investment is one you can stick with for decades, one that gives you good enough returns and lets you sleep well at night. Because only when you stay in the game long enough can compounding's incredible engine start working its magic for you. But if compounding is so powerful, does that mean all we have to do is start investing early and wait patiently? Not quite, because on the long road of investing, there will be unexpected challenges, moments that test your patience, shake your confidence, and tempt you to quit. So maybe the most important question isn't just about starting early. Maybe it's about how we make sure we can stay in the game and not get forced out halfway. That's exactly what we'll explore in our next part. We've now reached the final chapter of the psychology of money. Throughout this journey, we've uncovered some deep truths about saving, risk, and what it means to be free. But here's the thing. You can't learn to swim by just reading a book about it. You have to get in the water, and the same goes for money. Understanding these ideas is one thing, but applying them to your own life is where the real magic happens. Because when it comes to personal finance, there's no magic formula that works for everyone. As the author, Morgan Housel, puts it so perfectly at the end of his book, in personal finance, the word personal matters far more than finance. Think about it like going to the doctor. In the old days, doctors would just tell you what to do. But now, it's all about communication. Two people might have the same illness, but the best treatment for them could be totally different, depending on their lifestyle, their fears, and what they value. Money is exactly the same. Your age, your income, your family, your goals, and your fears, all these deeply personal things shape what financial plan is right for you. Advice from experts, or even from the author himself, is just a starting point. The real goal is to find a strategy that lets you sleep peacefully at night. So, how does Morgan Housel, the author, manage his own money? He's incredibly open about it, not as a guide to follow, but as a real-world example. His number one goal isn't to get as rich as possible. It's to be independent. He wants to wake up every single day and have complete control over his time, to decide what he wants to do and who he wants to do it with. He learned this from his dad, who saved relentlessly to retire early from a stressful job and finally pursue what he loved. For Housel, that kind of freedom is the greatest return money can buy. To get there, he and his wife focused on one simple thing: a super high savings rate. They made a conscious decision not to upgrade their lifestyle as their income grew. They kept living simply, finding joy in low-cost things like going for walks, reading, and listening to podcasts. This meant almost all their extra income went straight into their freedom fund. They weren't depriving themselves. They were trading short-term spending for long-term control. To protect that freedom, Housel even made some choices that might seem irrational on paper. For example, he paid off his house in full, even when mortgage rates were at historic lows. Why? Because the peace of mind of being completely debt-free was more valuable to him than the extra money he could have made by investing. He also keeps about 20% of his assets in cash, way more than most advisors would recommend. This isn't for returns, it's for security. It means he'll never be forced to sell his investments during a market crash. When it comes to investing, his strategy is radically simple. He tried picking stocks once but realized he couldn't consistently beat the market and didn't want the stress. So now he sticks to what works. He saves aggressively, stays patient, and puts his money into low-cost index funds that track the entire market. He contributes regularly, holds on for the long haul, and trusts in the global economy's growth. All his energy goes into what he can control: saving and patience. This is Morgan Housel's personal finance strategy. It's not about chasing the highest returns, and some people might even call it inefficient, but every single choice he makes aligns with his ultimate goal: independence and peace of mind. So, what does this mean for us? Housel doesn't share his story so we can copy it. He shares it to prove the book's central idea. No one is irrational with money. We're all just trying to make sense of the world based on our own unique experiences. Your financial plan doesn't have to look like anyone else's. The real takeaway is to understand yourself, what you truly want, what you truly fear. Then you can design your own game. You can find the path that brings you calm and aligns with your values. It might not be the fastest way to get rich, but it will be your way. And that, sleeping well at night, knowing you're on the right path for you, might just be the greatest return money can offer. In the last part, we talked about how just staying in the game is the hardest, most important part of investing. But does that mean you have to be perfect? What if you mess up, make bad calls, and most of your investments turn out to be duds? Are you doomed? Not at all. And the next big idea from The Psychology of Money is going to change how you think about winning and losing. It's a simple but powerful truth. In the world of wealth, the tails drive everything. What does that mean? It means a tiny number of extreme rare events are responsible for the vast majority of the results. All the little stuff, the everyday mistakes, the small wins and losses, they barely matter in the long run. You can be wrong most of the time and still end up incredibly successful. Sounds crazy, right? Let's look at the world of high-end art collecting. Think of the most successful art dealer in history. You'd imagine he had a magic eye, picking winner after winner. But the reality is, he operated more like an index fund. He bought tons of art, knowing that 99% of it would probably be average or even worthless. But that 1%, the Picassos, the Matisses, their value skyrocketed so much that it paid for all the other mediocre pieces and then some. His success wasn't about being right all the time, it was about being right on a few things that mattered immensely. This isn't just about art, it's everywhere. Take venture capital. VCs invest in dozens of startups, and they fully expect more than half of them to fail completely. A few might do okay, but they're hunting for that one unicorn. There's that one company that returns 50 or 100 times their investment. That single home run doesn't just make a profit, it pays for every single failure in the portfolio. That's the tail in action. You might think, okay, that's for risky stuff like startups. But what about the regular stock market? The same rule applies. A study of the Russell 3000 index, which covers almost all U.S. stocks, found something shocking. Since 1980, about 40% of all the companies in the index effectively failed, losing most of their value. 40%. Yet the index as a whole grew 73 times over. How? Because all of that growth came from just the top 7% of superstar companies. A handful of massive winners pulled the entire market up, making up for thousands of losers. This applies even inside companies. Think about Amazon. What drives their massive success? Two things, really: AWS and Prime. They've launched countless failed products like the Fire Phone. Remember that? Total disaster. But it didn't matter, because the success of their big winners was so monumental. Same with Apple. The iPhone alone defined its destiny. So, what does this tails drive everything principle mean for you and me? It means we need to stop thinking that investing is about being right all the time. It's not. Investing is more like baseball. Even the best hitters only get a hit 3 or 4 times out of 10. They fail more often than they succeed. Legendary investor Peter Lynch said if you're right 6 times out of 10 in this business, you're a genius. This means losing is normal. Having stocks that go nowhere is normal. It's all part of the game. Your long-term success will likely come from just a handful of big wins that you hold on to for a very long time. As George Soros said, it's not whether you're right or wrong that matters, but how much you make when you're right and how much you lose when you're wrong. So don't get discouraged by a few losses. Don't beat yourself up. And don't put other investors on a pedestal just because they had a few big wins. Even Warren Buffett admits most of his wealth came from just 10 investments. take away those few, and his record is pretty average. Once you understand this, you can face the market with a lot more calm. Your job isn't to be right all the time. Your job is to stay in the game long enough to catch those rare, game-changing tail events. And when you do catch one, have the courage to let it run. That's why leaders like Jeff Bezos and Reed Hastings aren't afraid of failure. They know that massive success is built on a long series of experiments that didn't work out. If success really depends on these unpredictable home runs and surviving a lot of failures, then what are we really trying to achieve with our money? Is it just about a bigger number on a screen? Or is there something more? In the next part, we'll explore what might be the single greatest thing money can buy: freedom. We've talked before about a surprising idea in investing, that ultimate success often comes down to just a few rare, big wins. This means we don't have to be perfect. We can make lots of mistakes and still come out on top, as long as we grab those few key opportunities. But this brings up a deeper question. If we spend years studying finance, managing risks, riding the market's ups and downs, and finally build some wealth, what's it all for? Is the goal just to watch numbers in an account get bigger? Or does money give us something more valuable than wealth itself? The book, The Psychology of Money, gives a clear, powerful answer. The most valuable thing money can buy is freedom, the ability to control your own time. The highest form of wealth isn't about luxury cars or designer clothes. It's waking up every morning and being able to say, "Today, I can do whatever I want." Think about what truly makes people happy. A famous study found that happiness has less to do with your income or how big your house is, and much more to do with your sense of control over your life. Having a strong sense of personal control is one of the most reliable predictors of happiness. Simply put, real happiness is spending time doing what you want with the people you love. And that's the greatest dividend money can give you, the power to take back control of your life. So how does wealth give you that control? It happens in layers. A small amount of savings means you can take a sick day without worrying about missing a meal. A little more, say a few months of emergency savings, means if you lose your job you don't have to panic and take the first bad offer. You can wait for the right opportunity. With even more savings, you gain more options, like choosing a job with lower pay but a shorter commute, or deciding when you want to retire instead of being forced to work. Each step up the wealth ladder buys you more time and more choices. The author, Morgan Housel, learned this firsthand. In college, he dreamed of working on Wall Street to make a lot of money, thinking it would bring happiness. He got an internship at an investment bank but quickly found himself miserable. The job demanded every waking hour, and getting home before midnight was a luxury. He realized that doing a job you like but with no control over your time feels almost the same as doing a job you hate. This is because of a psychological trigger called reactance. When we feel forced to do something, we instinctively resist it, even if we don't mind the task. That's how vital autonomy is to our well-being. The book also shares the story of entrepreneur Derek Sivers. When asked how he got rich, he didn't talk about the millions he made selling his company. He talked about being 22, making just $20,000 a year. He lived simply, saved up $12,000, and that small sum gave him the freedom to quit his job and pursue music full-time. For him, that was real financial freedom. Not the millions later, but the first nest egg that gave him control over his life. This reveals a modern paradox. We live in one of the wealthiest periods in history. We have more stuff, cars, homes, gadgets, than our parents ever dreamed of. And yet, happiness levels haven't risen. In fact, stress and anxiety are up. Why? A big reason is that while our material wealth grew, we quietly traded away control of our time to get it. A bigger house often means a longer commute. A fancier lifestyle requires a higher-paying, more stressful job to maintain. The joy from new things fades fast, but the pain of losing control over your time sticks around. Modern work makes this worse. In the past, many jobs were physical. When you clocked out, work stayed at the factory. Today, most jobs are mental. Our tools are in our heads, and they never turn off. We think about work on the drive home, answer emails at dinner, and worry about projects at 3 a.m. We might be richer, but we've become less free. So, what's the takeaway? The book mentions a study that asked over 1,000 elderly Americans for their life lessons. No one said, "Work as hard as you can to buy everything you want." Instead, they talked about genuine friendships, meaningful work, and spending time with their families. Your kids don't care how much money you make. What they really want is you. The ultimate message is this: the greatest return on your money isn't luxury or status. It's the ability to control your time and live life on your own terms. So, if money's true value is buying freedom, how do we get it? Does it mean chasing the highest returns? Or could the key lie in something much simpler and more controllable? Our saving habits. We'll explore that next part. Earlier, we talked about how the ultimate value of money isn't luxury goods, it's control. Control over your time, your choices, and your life. It's that deep sense of freedom from knowing you can live on your own terms. So, the next question is obvious. How do we actually build enough wealth to buy that kind of freedom? Does it mean working ourselves to death to increase our income? Or becoming investment geniuses chasing the highest possible returns? Well, the book, The Psychology of Money, offers a perspective that might surprise you, but it's one of its most important lessons. Building wealth has far less to do with how much you earn or how high your returns are, and a lot more to do with something you actually have complete control over: your savings rate. That's right, saving money. It sounds almost too simple, maybe even old-fashioned, but the author argues that saving is the most overlooked yet most powerful part of personal finance. Think about it. Increasing your income or getting huge investment returns is full of uncertainty. Economic cycles, market volatility, industry shifts, even random luck, none of these are fully in your control, but how much you save. That depends almost entirely on your own habits and your ability to manage your desires. That is something you can control. The book uses a great analogy: the energy crisis of the 1970s. Back then, people worried the world was running out of oil. But the real solution didn't come from discovering vast new oil fields. It came from becoming more efficient. Cars got better mileage. Homes and factories used less energy. Finding more oil was hard and uncertain. Becoming more energy efficient, however, was something everyone could do. The same is true for money. Chasing higher income or investment returns is like hunting for more oil. It's unpredictable. But increasing your savings rate is like improving your energy efficiency. It's reliable and within your control. The fundamental formula for building wealth is simple. Wealth equals income minus ego, or your expenses. Even if you don't make a lot, as long as you spend significantly less than you earn, you can still accumulate wealth. But the reverse is also true. You can make 6 figures, even 7, and still be broke if your spending rises just as fast as your income. Wealth isn't about how much you make, it's about how much you keep. And beyond that, the value of wealth is always relative to your needs. Imagine we both have the same net worth, but your investments earn 12% a year, while mine earn only 8%. You might think you're doing better, but here's the catch. If I can live happily on half your expenses, my financial position is actually stronger than yours. You're working hard to sustain your desires. I'm living comfortably below mine. So even though your returns are higher, my freedom, and maybe even my happiness, might be greater. Learning to enjoy life with less, to control your wants, and to keep your spending below your income, that's a form of wealth all by itself. And unlike market returns, it's something you have total control over. So how do you increase your savings rate? Of course, earning more helps. But the harder and more meaningful work lies in managing your psychological balance sheet. Once spending goes beyond basic needs, it often becomes a game of status. We start buying things not for utility, but to signal success, to show we've made it. That's why one of the best ways to save more isn't necessarily to make more. It's to cultivate humility. If you think of saving as income minus the desire to impress others, it suddenly makes sense why so many high earners are still living paycheck to paycheck. They're constantly fighting their own urge to keep up appearances. Meanwhile, the people who quietly build wealth usually share one trait. They just don't care that much about what others think. They're not worried about having the flashiest car or the biggest house, and when you stop caring about other people's opinions, a lot of unnecessary wants simply fade away, and your savings rate naturally rises. Now, let's go one level deeper. Do you really need a specific goal to save money? Many people say they're saving for a down payment, a car, or retirement. Those are great goals. But this book suggests that you can, and actually should, save money for no particular reason at all. Why? Because life is unpredictable. If you only save for known goals, you read like an engineer designing for only known risks, your system will fail the moment something unexpected happens. Life throws curveballs, job loss, illness, family emergencies, or maybe even an incredible opportunity that requires cash up front. You can't plan for every one of these, but you can prepare. That's what general-purpose savings are for. They're your financial airbag. It's money that gives you flexibility and buys you time and choices when the unexpected happens. When you have enough savings, you don't have to take the first job offer out of panic after a layoff. You don't have to sell your investments in a downturn. Every dollar you save without a designated purpose is a little piece of future independence, a bit of control you've reclaimed from uncertainty. Plus, this kind of redundant savings increases your staying power as an investor. Compounding takes time, and markets fluctuate. If all your money is tied to near-term needs, you'll eventually be forced to sell at the wrong time, interrupting the compounding process. But if you have ample cash reserves, you can ride out volatility without selling. As Charlie Munger famously said, "The first rule of compounding is to never interrupt it unnecessarily." This is why the book promotes the mindset. Save like a pessimist, invest like an optimist. It means you should acknowledge the world's risks and save as if bad things will happen, but also believe in humanity's long-term progress and invest your remaining savings optimistically. Be cautious to survive and be optimistic to thrive. We've covered so much, from understanding how our personal experiences shape our financial behavior to mastering compounding and realizing that money's highest purpose is freedom. And the key to achieving all of that? Saving like a pessimist. So how do we bring it all together? How does Morgan Housel, the author himself, apply these principles in his real life? That's exactly what the final chapter of this book reveals, his personal confession. We've now arrived at the final chapter of The Psychology of Money. Up to this point, we've explored so many profound insights about saving, risk, and freedom. But you can't learn to swim without getting in the water, right? Understanding these ideas isn't enough. You have to bring them into your own life and see how they fit your unique circumstances. When it comes to personal finance, there's no single right answer that works for everyone. That's why the book emphasizes something crucial. In the phrase personal finance, the word personal matters far more than finance. It's like going to the doctor. In the past, doctors made all the decisions for their patients. But today, medicine emphasizes doctor-patient communication, understanding the patient's preferences, mindset, and values. Finance works the same way. Your age, income, family situation, risk tolerance, life goals, and even your deepest fears are all highly personal. They determine what kind of financial approach truly fits you. Someone else's advice, even an expert's, is just reference material. What matters most is finding a way of managing your money that lets you feel at peace, that lets you sleep well at night. So, how does the author himself, Morgan Housel, put his philosophy into practice? In the final chapter, he shares a personal confession, not as a model you should copy, but as an example of how to integrate financial principles into real life. Housel starts by defining his central financial goal. It's not about maximizing wealth, it's about maximizing independence. He wants to wake up every morning with complete control over his time and his choices, to decide freely what to do and who to do it with. This mindset was deeply shaped by his father's story. Housel's father saved aggressively for years and eventually retired early, escaping a high-pressure job to pursue what he truly loved. That sense of being in control of his life, of owning his time, struck Morgan as the highest form of reward money could buy. To achieve that same goal, Housel and his wife committed to one key strategy: maintaining an extremely high savings rate. Early on, they decided their lifestyle desires would not expand endlessly with their income. Even as their earnings grew, they kept their standard of living relatively simple. As a result, nearly all their income growth went straight into savings, what Housel calls their freedom fund, and they rarely felt deprived. Their happiness came from low-cost joys like long walks and good books, not from consumption. They knew exactly why they were doing it, sacrificing short-term spending for long-term freedom. Housel also made several choices that, from a purely financial standpoint, might look irrational, but they made perfect sense emotionally. For example, during a period of historically low mortgage rates, he and his wife chose to buy their house outright instead of taking out a cheap loan and investing the difference. Why? Because the feeling of owning their home outright, the peace of mind and freedom from debt, was worth far more to them than a slightly better spreadsheet outcome. Likewise, they hold far more cash than most financial advisors would recommend, around 20% of their financial assets. Again, not for returns, but for resilience. That extra liquidity ensures that no matter what happens in the markets, they'll never be forced to sell their stocks at a bad time. That sense of safety, the ability to withstand surprises and stay in the game for the long term, is a trade-off they're happy to make. When it comes to investing, Housel's strategy is almost minimalist. He admits he's tried picking individual stocks but quickly realized two things. First, he couldn't guarantee he'd outperform the market, and second, he didn't want to spend his life worrying about it. For him, if a high savings rate combined with decades of patience in low-cost index funds can achieve all his family's goals, then why chase something more complex and more stressful? So, after setting aside their cash reserves, he and his family put nearly all their long-term investments into simple, diversified, low-cost index funds. They invest regularly, hold long-term, and trust in the steady upward trend of global economic growth. Almost all their mental energy goes into the two things they can actually control: saving consistently and staying patient. That's Morgan Housel's personal approach. It's not about extreme returns, and it might look unoptimized from the outside, but every single decision serves his deepest goals: independence and peace of mind. Housel doesn't share his story so that you'll copy it. He shares it to reinforce one of the book's most important ideas. Nobody is truly irrational with money. Everyone is simply making sense of the world in their own way. Your approach doesn't need to match his or the experts. It doesn't even need to match the version of yourself from yesterday. What matters is self-awareness, understanding the human instincts and emotions that drive your financial behavior. Once you see clearly what you truly want and what you fear most, you can design a money strategy that's aligned with you, your values, your temperament, and your goals. That personal alignment is the foundation of lasting financial peace. The path you choose might not be the fastest or the one with the highest returns, but it'll be the one that fits you best. It's the path that lets you sleep soundly at night. And in the end, that may be the greatest wisdom and happiness money can ever bring. Thanks for watching. Don't forget to like and subscribe for more content like this.